Good day, investors. Today we are looking at another mining company, BHP. It's a global giant. It has iron ore mainly. Copper is skyrocketing compared to previous years. Nickel, not doing so well. Coal and potash is coming up. It's a simple to understand business, but really cyclical and dependent on global commodity prices. Scale and cost leadership is basically their moat, given they are price followers because they are selling commodities. They have a really disciplined shareholder focused capital allocation management with a strong dividend policy of payout of 50% of underlying profits, low debt, and focusing on the future. The intrinsic value is around $50 per share with a 3.9% dividend yield. They have a solid cash flows and balance sheets, but they are not cheap. Especially not cheap if you compare it to the volatility commodity prices give this business. Global mining giant, producing iron ore, copper, nickel. We will see the breakdown by segment. Potash is coming up in a new development. They are clear and easy to understand business, but it's really cyclical and profits depend on commodity prices. This is from their 2025 annual report. Keep in mind that the year ends for them as June 30. So it's kind of semi comparing to the others because you don't really have the same period to line up every detail. So what they focus on is the megatrends for the commodities. You have population growth, you have urbanization, increasing living standards, data centers, AI, all the stuff that say are driving growth for them. And this is their asset allocation. This is Janssen, that's their potash era. Their new potash producing asset. It's still in production, but it's going there. You see copper, you see iron ore. Iron ore is the biggest by far segment for them. So they had the 2015 Samarco incident, which is, I think, still in litigations in the UK at least. They have a 50-50. Samarco is a 50-50 JV joint venture with Vale. Okay, operational excellence, margins. Okay, yeah. Minimum dividend, yes. They have a 50% payout as a minimum dividend of their underlying profits. All good. Reshape the portfolio to leverage megatrends. So we also have to keep in mind they sold out their petroleum. So here you can see it. It was a rather large chunk back in 2016, but then they sold it and there is no petroleum from 2022. You could argue that they sold just before oil prices shot up in 22, 23, but that's, you cannot really plan for that. And then what you can see clearly is that iron ore is by far the largest segment, and copper. Look at copper; it's skyrocketed. When I was comparing unit costs based on my mathematical calculations, copper cost per unit drastically became more efficient because of the volume increase and everything. So that was a really good surprise. That look at this. This is EBITDA by commodity. Copper is a large chunk. So iron ore is still huge, but not as big. If you look at 21, actually, you see that iron ore was way more than today. But that's because 2021 iron ore prices went above $200 per ton. So that was huge. They are sort of selling off coal. Copper is increasing. Potash is not yet done. It's coming right back. It's coming with the Janssen project in Canada. So this is actually a really good outlook. Copper, good. Iron ore, cash cow. And potash. We'll see about potash. And then this is just context. These are all the iron ore producers, the major producers. You can see in purple, iron ore prices go up. Shares for these producers go up. Iron ore prices go down. Share for these producers go down. So I go back, they are mainly iron ore. Now they have copper coming up, so they try to hedge basically iron ore prices, although copper and iron ore both are industrial metals, so they tend to move together. Moat, they have a huge scale and cost. They are lowest cost producer, among the lowest. So they have, this is their official numbers, 18.6 is their unit cost for iron ore. Keep in mind that for Vale, for Rio, and for Fortescue, I use 2024 annual reports numbers, 2024. But for BHP, this is their 2025 annual number. So because of the reporting is in June and not in December, I think the 24 number was 18.2. So it's sort of between like 18.4-ish if you would compare it maybe across time. But they are low cost, and then you can see that in their return on investment over the last 7 years. It's really decent. They have high quality assets. Their capital intensity of the business in itself is really putting up a barrier for anybody to compete with these four giants. And of course, they have no pricing power because the commodity is a global price, a global market that sets them up to be exposed. Looking at management, this is from the 25 report. Management is paid by, this is their targets, 25% safety, sustainability, okay, 50% financials, weight, and group and personal. So financials include return on capital employed, really good. They have total shareholder return relative to MSCI World Index and sector peers. Okay, makes sense. Interestingly, they have a maximum 15% capital growth in their incentive structure, so that's good. They are not going to overcommit. They're gonna be really disciplined, and it's a key: disciplined capital allocation and focus on shareholder returns. Their dividend policy is 50% payout of underlying profits minimum, so they can pay out more if they want to. They reduced debt, divested petroleum, and invested in future-facing minerals like copper, and then they are executing on that strategy. You see a couple slides before, petroleum is gone with 21, and then copper is skyrocketing compared to previous years. They have strong dividend record. Yes, I think that's an important approach from management towards shareholders, and they are improving on their ESG, which is good from institutional investing perspective. So if you want to attract, for example, pension fund money, you will have to have a nicer ESG outlook, and just generally as a mining company. So if you want to invest in third world countries, in other countries, doesn't have to be actually third world, but in any countries, you want to have good track record of safety, sustainability, not destroying the environment around you, and not treating people badly, your employees. So that helps you to secure deals, assets, and to protect those, and in the end, protect your shareholder. On their shareholder remuneration history and debt side, you can see that when 2022, 2021, when you have good boom in commodity prices, they are producing outstanding cash flows, free cash flows. What is interesting to me is that 2021 you had peak iron ore prices, but they still made more money in 2022. If you would look at the Vale video, you would see Vale peaked in 2021, and I think Rio Tinto also in 21, because those companies are more heavy on iron ore. As you saw, BHP is heavy on iron ore, but they are building into copper. I don't want to say nickel because it's not profit making, and other metals and some coal. So they are a bit more diversified. And then you can see their policies that they don't do that many buybacks. 2019, you saw buybacks, but every other year they did mostly dividends. If you follow this channel, you know that I always say commodity producers tend to buy back stock when the stock price is high. Why? Because they get money when the underlying commodity, let's say oil or iron ore or whatever, is high. They get more free cash flow, and then they buy. And because the commodity price is high, the share price is kind of tracking the underlying commodity, so the share price goes up. They have more cash and they buy back shares at the high. When fast forward to 25, you have lower free cash flows. They don't have cash to buy back shares. So it's really destroying capital if a company would buy back shares when they are high and not have cash when they are low. What they do is they just pay out dividends, which is perfectly fine. If they have excess cash, that's the best way to help your shareholder. And then the shareholder can invest elsewhere or just put it in treasuries, wait until BHP collapses or goes down in price, as it will, because it's a cyclical business, and then you can buy shares at the lows. Optimize capital expenditure. So what they are aiming at is around 10 billion going forward. So that's also what I'm using in my projections. 10 billion capex. You see, Janssen is a major project in the Canadian potash. I think 10 billion is reasonable, and 2025 they were slightly below, like 9.8 or 9.7 billion, so they're tracking that 10 billion target. And with that we can go to valuations. So here you can see I use the 10 billion capex, and I use a 10% required rate of return and then I put together all of the EBITDA of their segments. You have iron ore, and I calculate manually their break-even prices based off the financials they provide in their annual reports, and adjust for reducing other expenses and taxes from the whole picture. So they are going to produce this much iron ore. They say 1.4% growth overall for all their segments. So I just use 1.4% growth rate for every type of production. For coal, for iron ore, for copper. Coal is a relatively small segment. And then you have a free cash flow, discounted free cash flow value of around 50 per share. The company as a business, so it's not just underlying value, as a business, they are decently profitable. So they are not like a tech giant, but they have a return on equity of 7.8, and this was a relatively weaker year. If you compare over the 7 years, they have 27% return on equity. Return on investment is also nice. The debt is manageable. It's in the 40s. Their cost of debt is relatively low. Although you see a rise because interest rates were higher in the last couple of years than in the previous 7 years. They are easily covering the interest payments, and then they are liquid enough. They have to be liquid as a major commodity producer because of the volatility of your business. So if you are selling alcohol or tobacco, usually the business is not as volatile. You can get by with way lower current ratio because the turnover of your inventory is short. For them, it can vary, and they have more. They might have more liquidity needs because the underlying prices, and the trailing 12-month dividends around 4%. That's not too high, and the free cash flow yield on today's market cap, which is around $144 billion. I think last year free cash flow for 2025, which ended in June 30, it was around 9 point, a couple slides before we can see, but 9 something billion. You have a 6.5% free cash flow yield. I don't think that's enough of a margin of safety for me because it's a really volatile business with commodity prices, iron ore, which depends a lot on China, and also copper depends on China and global demand. And then you have always these operational and geopolitical risks. You have the operational risk side as mine collapses, injuries. You had the Samarco incident in 2015. Vale had Brumadinho in 2019. So those can really put like huge costs, liabilities, fees, reparation costs, all sorts of misery into these mining companies' lives. And you have the geopolitical risk. You have assets sitting in maybe countries where it shouldn't be, and then maybe that country turns against you. So it happened, if you recall, to Barrick's, one of Barrick Gold's mine was taken in an Asian country. So it's a risk. So you want to be compensated for that. On the summary side, global mining giant, mainly iron ore and copper. Let's forget about the rest, except potash, but it's in production. Straightforward business, but it's really cyclical. Moderately predictable. I would put very moderately predictable. You have a massive scale, and being a top tier asset producer, you have high cost of entry. You don't have pricing power, so you have to be operationally really efficient, which BHP is. So that's a moderate mode for them. So they are more efficient than Vale or Rio Tinto. From management perspective, they are really disciplined with their capital allocation. They are shareholder prioritizing. They are not buying back stock when the stock price is sky high because of the underlying. So they are smart with their capital allocation, not overspending on capex, but also not destroying shareholder value when they return cash to shareholders. Debt is under control, and they had a nice shift into copper, which I appreciate. I put their intrinsic value around 50. If you look at the chart here, BHP, industrial metal, Australian, yeah, it trades around 56. My value is around 50. So that would mean if I want to get a 10% return, I would have to pay 50. Today I'm paying 56. That's not really the return I'm looking for. And given there is no margin of safety, so there is no margin of error. What if my discounted cash flow calculation is too optimistic on production increases or future prices of those of the commodities? So I would like to see a lower price. And also their 7-year average is in the mid 50s. So over the cycle, let's say it's 55, is a 10% return for you. I don't see enough margin of safety for me. What if maybe you want to buy this company when they have a huge collapse or where commodity prices are rock bottom? If you buy on good prices, you can hold it forever because it's solidly profitable. It has nice cash flows, but it has risks. So you want to have a nice margin of safety. Fairly valued, not cheap. That would sum it up. If you enjoyed this video, please like and subscribe, and let me know of companies you want to see, and leave comments below. Take care, guys. Cheers.